Now to one area of the market that is heating up, and that is the deal space. M&A has been a key theme in 2019, with oil giants Chevron and Occidental battling over Anadarko, and Bristol-Myers Squibb buying biotech rival Celgene for $88 billion. And you guessed it, there is a way to capitalize on these mega mergers using ETFs. Joining us now is Sal Bruno, Chief Investment Officer at IndexIQ and Managing Director at New York Life Investments. He is the man behind an ETF capitalizing on recent mergers and acquisitions. So Sal, explain to us how this M&A ETF works exactly.
So it's great to be here. Thanks, Leslie. So M&A is a passive ETF. So we run a systematic or a rules-based process to try to capture as many merger arb deals as we can, with the general idea being the more deals you have, and with the premium and completion rates, you have the opportunity to pick up some of those premiums and deliver valuable returns to the portfolio.
So is the thought here that, because it's systematized, that the deals that are announced will more likely than not close, or do you look at the potential probability for certain deals to close over others, whether it's due to antitrust concerns or CFIUS regulations or other areas that, traditional hedge fund merger arbitrage shops will really kind of pride themselves on focusing on?
So being that it's a systematic process, we expect to have fairly high completion rates, and that's what we're trying to capture here. So if you look at the completion rates, it's actually improved over the last 3 years with this administration. So the cancellation rate has actually gone down. It's somewhere probably around 85 to 90% of the deals are successfully capturing or successfully closing. And so that's really what we're trying to capture there, is the premium associated with those deals. By owning approximately 40 to 50 names at any point in time, we're trying to diversify some of that specific risk of one particular deal breaking, but really trying to capture the overall premium associated with merger arbitrage investing. So
is the ETF long the target, or does it also go short the acquirer as well, as a traditional merger arbitrage strategy would entail?
So we will go long the target company, and we have a systematic process that we run that would identify the target companies that meet our criteria that get put into the portfolio. Where we differ a little bit is on the short side. So we don't short the acquirer, we actually short the sector of the acquirer, because we're trying to provide broad protection against downside moves related to a specific event in an industry, a sector, or the broad market. So if you look at a day like today, for example, where the markets are down about 1%, even with only about a 35% hedge, it's actually been fairly effective at protecting against the broad downside move. So M&A is actually pretty close to flat on the day.
All right, I think Todd had a question.
Yeah, Sal, just curious from a sector diversification standpoint, it sounds like you've got tech and healthcare and energy as some of the leading ones. Have you seen historically a rotation among sectors in the M&A space?
There is a rotation among time, and you're correct. Those are the three largest sector weights we have currently, financials being another one. Importantly, though, because we're putting the hedges on, so even though we have probably about a 25% weight in technology, we're actually short about 12% on the technology sector. So as we've seen some of the semis come under pressure with the China trade issues and CFIUS, that's actually provided a very good downside protection, again, against that broad down move that's affecting the entire sector.
So is that diversification benefit, is that the advantage to investing in upcoming deals using an ETF rather than just buying the individual names outright, that you do get kind of a broader base of deals that you're looking at to receive those diversification benefits?
Yeah, so for an individual investor, it would probably be pretty difficult to own 40 or 50 deals and then to identify the hedges and to put those on. Clearly doing it in a structure like an ETF gives you that diversification. But then also you look at the additional benefits of the ETF relative to other structures, say a mutual fund or limited partnership type hedge fund. ETFs, the M&A has all of the benefits of a traditional ETF, including transparency, liquidity, and tax efficiency. So that's why we think it's actually the preferred vehicle for a strategy like this.